December 26th, 2025. While most people were unwrapping presents and arguing about politics over leftovers, silver did something that should have stopped every financial news channel in its tracks. It touched approximately $79.30 per ounce, the highest price in recorded history, not adjusted for inflation, nominal. Raw, record-breaking. And here's the part that should make you pay attention. This isn't happening in isolation. This is happening while gold simultaneously breaks through $4,500, while platinum hits all-time highs, while every major precious metal on Earth is screaming the same message at the same time. And that message isn't about inflation. It's not about interest rates. It's about something deeper, something structural. And if you don't understand what's driving this move right now, you're going to miss what happens next. Because the question isn't whether silver hit a record. The question is whether $79 is the exhaustion point where everyone who bought takes profits and runs, or whether it's the launch pad for a move that makes $79 look cheap 6 months from now. And to answer that question, you need to understand three things that are happening simultaneously. 1, industrial demand that cannot be substituted. 2, a supply deficit entering its 5th consecutive year. And 3, a geopolitical and monetary backdrop that's pushing physical assets to the front of the line. Let me show you exactly what's happening, why $79 either marks the top or the beginning, and what the actual data says about where this goes next. First, let's get the facts straight. Silver opened 2025 at roughly $29 per ounce. By December 26th, it hit around $79. That's a 173% gain in 12 months. Not 12 years, 12 months. To put that in context, silver hasn't moved this aggressively since 1979, right before the Hunt brothers tried to corner the market and pushed it briefly to $49 in 1980. But here's the difference. The 1980 spike was speculative manipulation. This is structural imbalance meeting monetary fear, and that combination is far more dangerous for anyone holding paper promises instead of physical metal. Now, before we go further, let me address the elephant in the room. Is this sustainable? Can silver really hold $79 when it spent most of the last decade bouncing between 15 and 30? And the answer requires understanding what's changed, because something fundamental shifted in this market, and it's not going back. Let's start with industrial demand, because this is where most people get it wrong. They think of silver as a monetary metal like gold, something you buy as a hedge and store in a vault. And while that's partially true, it misses the bigger picture. Silver is the most industrially essential precious metal on Earth. It has the highest electrical conductivity of any element. It has the highest thermal conductivity. It's antimicrobial, reflective, and ductile, which means it shows up in technologies where performance isn't optional. Solar panels, electric vehicles, 5G infrastructure, medical devices, AI data centers, and every single one of these sectors is expanding at double-digit rates. According to the Silver Institute's December 2025 report, industrial demand for silver hit 680 million ounces in 2024. That's a record. And 2025 is projected to exceed 700 million ounces for the first time in history. Now, here's why that matters. Industrial users don't care about price the way investors do. If you're building a solar panel and you need 20 grams of silver to make it function, you don't have a choice. You can't substitute copper or aluminum without sacrificing 30% of your efficiency. You pay whatever silver costs, because the alternative is a product that doesn't work. And solar demand alone is staggering. The International Energy Agency reports that global solar installations doubled in just 2 years. Each panel requires 15 to 20 grams of silver. By 2030, the European Union alone is targeting 700 gigawatts of solar capacity. That's not a forecast, that's policy. Which means that silver demand from solar alone could consume nearly 30% of annual global supply within 5 years. And that's before you add electric vehicles. EVs use 25 to 50 grams of silver per vehicle. That's 67% to 79% more than internal combustion engines. And by 2027, according to Oxford Economics, EVs will overtake traditional cars as the primary source of automotive silver demand. We're not talking about a trend you can reverse. This is infrastructure. And once it's built, it consumes silver for 25 to 30 years. Solar panels lock silver away for decades. EV charging networks are permanent installations. And this isn't cyclical demand. This is structural, cumulative, and accelerating. Now here's where it gets interesting. While industrial demand is hitting records, supply is doing the opposite. It's shrinking. Global silver mine production peaked in 2016 at 900 million ounces. Since then, it's declined at an average rate of 1.4% per year. In 2025, mine production is expected to reach roughly 813 million ounces. That's a 10% drop from the peak, despite silver prices more than doubling. And here's why that's so critical. About 70% of silver comes as a byproduct of other mining: lead, zinc, copper, gold, which means silver supply isn't driven by silver prices. It's driven by demand for base metals. and base metal prices have been weak. Zinc is depressed. Copper is choppy. Lead is stable, but not expanding. So even though silver is at $79, miners aren't rushing to open new silver projects because most of them don't mine silver primarily. They mine other metals, and silver just tags along. This creates a structural ceiling on supply that price alone cannot fix. New mines take 10 to 15 years to develop. Environmental permitting is tightening globally, major ore bodies are depleting, and the exploration budgets during silver's bear market from 2011 to 2020 were gutted, which means the project pipeline for new supply is thin, dangerously thin. This is where the deficit comes in. For 5 consecutive years, the silver market has consumed more silver than it produced. The cumulative deficit from 2021 to 2025 is estimated at 820 million ounces. That's an entire year of global mine production. Gone, drawn down from above ground inventories. And those inventories are not infinite. COMEX registered silver, the metal available for delivery against futures contracts, dropped from 290 million ounces in 2021 to around 210 million ounces by late 2025. That's a 27% decline. London vaults, which held over 31,000 metric tons in June 2022, fell to 22,000 metric tons by March 2025. That's a third of London's silver vanishing in less than 3 years. Now, why does that matter? Because when physical inventories drop, the paper market becomes fragile. Futures contracts are promises to deliver silver. But if the silver isn't in the vault, those promises become problematic. In October 2025, silver lease rates, the cost to borrow silver, spiked to 200% annualized. That's not a typo. Traders were paying 200% to borrow silver overnight because there wasn't enough physical metal available to close their positions. That's not a normal market. That's a squeeze forming. And here's the part most people miss. This isn't a temporary squeeze caused by a single buyer. This is a structural shortage caused by 5 years of deficit, while industrial users, investors, and central banks all compete for the same shrinking pool of available metal. So let's connect the dots. Industrial demand at record highs and rising. Mine supply declining. Cumulative deficit equivalent to an entire year of production. Inventories falling. Lease rates spiking. And then you add the monetary layer. Central banks bought over 1,000 tons of gold annually for the last 3 years. That's the highest sustained buying since the 1970s. Why? Because they're diversifying away from dollar reserves. And while central banks focus on gold, silver benefits from the same dynamic. When trust in fiat currencies erodes, tangible assets become insurance. And the signs of that erosion are everywhere. The U.S. national debt is $38 trillion. Interest payments alone are approaching $1.2 trillion annually. The Federal Reserve is trapped between controlling inflation and supporting markets. Geopolitical tensions are fragmenting trade. Russia was cut off from SWIFT in 2022. China is building alternative payment systems. Sanctions are weaponizing currency access. And every country watching understands the message. If you cross the U.S., your dollar reserves can be frozen. Your access to the financial system can be revoked. Your wealth isn't safe unless it's in your physical possession. This is why silver's 2025 rally is different from 1980 or 2011. In 1980, the Hunt brothers speculated. In 2011, investors panicked about the debt ceiling. But in 2025, you have industrial users bidding against investors, bidding against governments, all competing for metal that isn't being produced fast enough to meet demand. That's not speculation, that's scarcity. And scarcity doesn't resolve quickly. Even if silver prices double from here, mine supply won't respond for years. Even if industrial users try to substitute, most applications don't have viable alternatives. Even if investors take profits, the structural deficit remains because industrial demand doesn't care about price volatility. So is $79 the top or the launch pad? Let's look at what the pattern suggests. Some market observers are projecting targets in the $85 to $100 range by mid-2026 based on current supply-demand fundamentals. More aggressive independent forecasts suggest even higher levels are possible if the supply-demand imbalance intensifies. And here's the key insight. None of these projections assume a crisis. They assume current trends continue. Solar expansion, EV adoption, supply constraints, deficits. That's the baseline. But what if trends accelerate? What if geopolitical tensions worsen? What if the dollar weakens further? What if central banks shift even 1% of reserves from bonds to metals? Silver is a $50 billion market. Gold is $500 billion. A 1% reallocation from bonds to metals would flood silver with demand it cannot absorb at current prices. Now, let me be clear. This doesn't mean silver goes straight up from here. Momentum this strong invites pullbacks, profit-taking, volatility. Silver could easily correct 15 to 20% and still be in a structural bull market. In fact, corrections are healthy. They shake out weak hands and allow stronger accumulation at better levels. But the difference between a correction and a collapse is whether the underlying fundamentals remain intact. And right now, those fundamentals are stronger than they've been in 40 years. Here's what you need to understand. The people who bought silver at $15 and sold at $30, thinking they doubled their money, missed the move to $79. The people who are selling at $79, thinking this is the top, might miss the move to $100 or $120. Because tops don't happen when fundamentals are improving. They happen when supply floods the market or demand evaporates, and neither of those conditions exist right now. Supply is constrained by geology, permitting, and the byproduct nature of silver mining. Demand is locked in by industrial applications that can't be reversed. Solar panels installed today will consume silver for 25 years. EVs on the road will need replacement parts with silver components. Data centers powering AI are permanent infrastructure. This isn't demand that disappears when prices rise. This is demand that has to be met regardless of price. And that's why $79 might not be the top. It might be the moment the market realizes that silver is inexpensive at 79. It's undervalued relative to what's coming. Because when industrial users start panicking about supply security, when governments designate silver as a critical mineral, which the US did in 2025, when physical shortages force users to pay premiums far above spot prices, that's when 79 looks cheap. In late 2025, physical premiums for silver coins and bars are already $5 to $10 over spot. Delivery times are stretching. Dealers are rationing inventory. These are not signs of a market topping. These are signs of a market where paper prices haven't caught up to physical reality. And when that gap closes, when futures contracts demand delivery and vaults can't deliver, that's when price discovery becomes violent. Now, what does this mean for positioning? If you don't own silver, $79 might feel expensive. But expensive relative to what? Relative to $29 a year ago? Sure. Relative to $100 a year from now? Maybe not. The question isn't whether silver is expensive. The question is whether the conditions driving it higher remain in place. And the answer is yes. Industrial demand rising, supply constrained, deficits continuing, inventories falling, monetary uncertainty increasing. All of those drivers are intact. Which means positioning isn't about timing the perfect entry. It's about recognizing that structural shifts create long-term trends. And those trends don't move in straight lines, but they don't reverse until the underlying conditions change. And nothing about the current setup suggests those conditions are changing anytime soon. Here's the takeaway. Silver just hit approximately $79, the highest price in history. And the people asking whether this is the top are asking the wrong question. The right question is whether the forces that drove silver from 29 to 79 are exhausted or accelerating. And when you look at industrial demand hitting records, supply deficits entering year 5, inventories falling, and monetary uncertainty rising, the answer becomes clear. This isn't the end, this is the middle. Because tops happen when everyone believes the story. When dentists are buying silver coins and headlines scream about the next great trade. Right now, most people don't even know silver broke records. Most portfolios have zero exposure. Most investors are still debating whether 79 is sustainable. And that's exactly what the middle of a structural bull market looks like. Not euphoria, recognition. So whether you're holding, buying, or watching from the sidelines, understand this. Silver at $79 isn't expensive because of where it's been. It's expensive because of where most people think it's going. But if the structure underneath this market is what I've shown you today, then 79 isn't the top. It's the launch pad. And what comes next won't be driven by speculation. It'll be driven by supply, demand, and the uncomfortable reality that the world needs more silver than it can produce. Now, if you want to understand how to actually position yourself in this environment, not just watch it happen, I put together something critical. The 3 silver positions that protected wealth through every modern crisis. Not theories. Actual positions that worked in 1980, 2008, 2011, and are working right now. That video breaks down exactly what to hold, how to hold it, and why most people get this completely wrong. Links in the description. Because understanding the setup is one thing, positioning correctly is another. And right now, positioning matters more than it has in 40 years.